Good evening, ladies and gentlemen. Welcome to yet another edition of HR Learning Mentorship Series. Tonight, our facilitator is Tunde Wale Temowo, who is a regular on this platform, always eager to generously share his wealth of experience around HR issues. Tonight, the topic we'll be looking at is on retirement fund management in Nigeria, the realities, regulations, choices, and prospects. But just in case we have one or two people who may not yet be acquainted with the profile of Tunde, I'll be reading about him so that we can get better familiar with him. All right, so let me just say that Tunde is a certified professional in the field of human resource and also project management. He's certified as SPHRI, SHRM, SCP, and PMP. He has hands-on experience and core competency in human resource management. He is also a member of the Society for Human Resource Management. Currently, he works with the Nigerian Mortgage Refinance Company, NMRC, and he is the pioneer head of the HR function. Okay, he has also worked previously as a management consultant with KPMG Nigeria, focusing on people and change management. He worked as a technical advisor on human resource and program management for the Security and Exchange Commission, SEC. He performed the role as an embedded technical resource on secondment from KPMG. On this assignment, he assisted the Commission in rolling out its redesigned organizational structure. The assignment involved conducting high-level assessments for the Commission's senior staff and subsequently fitting staff into appropriate function on the new structure. Prior to that, okay, he had helped to set up the HR function of the Nigerian Sovereign Investment Authority as a human resource lead, also on secondment from KPMG. In that role, he had responsibility for the authority's human resource value chain, from recruitment and selection, policy definition, staff onboarding, statutory compliance, payroll, and so on and so forth. He has also led various teams to provide HR advisory service to major public and private sector organizations. Tunde had also previously worked in one of Nigeria's leading commercial banks, where he had a 2-year experience that cut across both business and operations functions. He holds a master's degree in business administration with specialization in human resource management from the University of Leicester and a bachelor's degree in building from the Obafemi Awolowo University. I don't mind getting a great Ife around this area. He has participated in a variety of trainings, both locally and internationally. Ladies and gentlemen, let's welcome to the virtual lectern once again, Tunde Wale Temowo. You have the floor.
Okay, thank you very much, Tallest. It's always a pleasure to be here and to share knowledge on this platform. I mean, I will say that the HR mentorship group is one of my most prized resource centers, so to speak. You know, I just need to just dump something on the group, confused, and get a lot of input from people. So once again, thank you so much for putting this together. Thank you to everybody who is a part of the HR mentorship community. And welcome to everybody, those who are members of the HR community and our friends who are not HR practitioners, as it were. We do this, to share knowledge and to improve, on one another, as the case may be. So yeah, tonight I'm going to be talking about retirement fund management in Nigeria, and this is something that impacts on everybody. I want to believe, permits me to make this assumption, that everybody in this room and those that will still be joining are people who are either actively working and contributing most likely to the pension scheme, or perhaps we have some people who have retired and are already enjoying their pension. in our midst. Or maybe we also have some people who have not exactly entered into the employment market, probably students who are looking to get a job later, or youth corps members, interns, who would someday also be RSA holders and contributing to pension. So whoever you are, whatever your paradigm is, I believe this is something that impacts on each and every one of us. And some of the things that I'm going to be talking about will be familiar, of course. And there are some things that will be like, oh, really? Oh, I didn't know that's how that works. There are a few things that have changed around how pension is managed in Nigeria that we're also going to talk about, and talk about the intricacies of some of these things. And of course, we look at the history of our pension or retirement fund management in Nigeria. So basically, that's what we're going to be discussing tonight. And what are the objectives? What do we want to achieve at the end of it? To have a better appreciation of the pension industry in Nigeria, and particularly the 2004 pension reforms in Nigeria. That was a major watershed in the administration of pensions in Nigeria. So what was it about that reform? Why was that reform necessary? And what have been the benefits of that reform? We're going to talk about that. Who are the players in the Nigerian pension industry today? What are their roles? We'll talk about that. And of course, finally, to look at what are the trends that we have seen in this industry, what are the challenges, in that industry. Some news out there that could worry you. You hear some things about your pension funds and you're like, wow, is my money safe? We're going to discuss those as well, and also look at what does the future hold for management of retirement funds in Nigeria. And this is just the outline that I have. So let me dive into it for our time. So, we're talking retirement benefits. Of course, largely what jumps at you is pension. But pensions are not the only retirement benefits. If you retire today, yes, most likely, if you've been contributing, you would get a pension. But some people get more than pension. Some people also get what is called gratuities or severance pay. Those are retirement benefits as well. So what is pension and how does it differ, from these other benefits? So a pension, and you could have 1,001 definitions of what a pension is, but in the simplest of terms, I've said here that a pension is a regular, lifelong income that is paid to persons who are no longer in active service. That is, they've worked and they've retired, and this is what they are getting, on usually monthly basis. At least in Nigeria, the pensions come, on a monthly basis. So it's a regular, lifelong. And when I say lifelong, it's because all things being equal, if you're a pensioner, you are meant to get your pensions monthly, as it were in Nigeria, till demise happens. So it's a lifelong payment that comes into the hands of somebody who is no longer in active service. And of course, there are now different ways by which this works, which we're going to talk about. So how does it differ from gratuity or severance pay? Now, those ones are one-off payments that are made in recognition of service. So while pension is till the person eventually dies, gratuity is a one-off thing. It's gratis, as the word goes. You say thank you for working, for investing 30 years or 35 years of your life in this organization. Take this, as our appreciation of your contribution. That is what a gratuity is, or severance pay, as some organizations may call it. So those are usually one-off. Although I had to quickly point that out, because I imagine some people say, no, I've seen some severance that they didn't give the person severance at once. Now, I'm not talking about gratuity that government pays that you sweat for 2 years before you get it. There are people who they'll tell you they've retired for 5 or even in some cases 10 years and they've not paid their gratuity. That's not how gratuity is meant to work. Gratuity should follow you home as you are leaving service, and then pension is what you're getting continually. So it's not in that sense that I'm saying that in some instances a severance pay may be staggered. There are some organizations, who actually, for certain reasons, will stagger severance payments. And one of such reasons why an organization, I've seen this happen in private sector, especially for C-level people, executive management people who retire, they may stagger the severance pay over 2-3 years or in tranches, largely because they want to have recourse to be able to claw back in the event that this person has left. After he left, we now found out that, oh, while he was our CEO, he was cooking the books while he was our CEO. And, we had given him a very beautiful severance pay. He has gone. And now we are realizing that, bros, you actually had buried, some corpses here that were just unearthing after you left. So that's maybe one reason why some organizations will probably stagger severance pay. For some, they may say that, okay, yes, even though you finish your tenure, so let's say you were a CEO in this organization and you've done your 10 years or 8 years, as the case may be, and then you left in good conditions, no issues, you did well in the company, we pay you severance. But it's possible that, yes, even though you are 60 or you've done 10 years, you finish your tenure, you're still quite active enough to go and take up another employment with a competitor. That happens. Somebody used to work with one cement company in Nigeria, and then he left and as CEO of the cement company, and then he moved and joined another cement company, as CEO. So that's like a competitor thing. So for some organizations, they may say, okay, you know what? We won't pay you all your severance pay within a period of so time, provided that you don't join competition after you have left. So those are just a few of the exceptional cases where a severance pay or a gratis may be staggered. But ideally, typically, those are actually a one-off payments, unlike pensions. I want to believe that is pretty much clear. So how was the pension? So I'm going to focus more. I just needed to clarify that about, gratuity payments, how they are different from pension. But my focus tonight is actually going to be largely on pensions and the pension industry in Nigeria, how it has evolved and what are the things that are happening in that space. So yeah, let's look at a bit of history about the Nigerian pension industry. I did the bulk of this research well over 10 years ago in my previous job. Now my first exposure. So let me just add this to for those who joined earlier. While Oluyemi was reading my profile, he did mention that I worked at KPMG, and I remember one of the very interesting assignments that I did then in KPMG was in 2008, where we were engaged by PENCOM, the pension industry regulator, to help define a 5-year strategy, for pension. And that was my first exposure, so to speak, to the pension industry. Yes, I was contributing to pension, but because I didn't really pay attention to what I was about. But getting on that assignment actually helped me to appreciate, the pension industry, and it's something that I've actually been quite interested in over the years. So, I mean, this was I had to update this, of course. In preparing for this, I had to update this, but the bulk of the pre-2004 items that you have here were done back then in those research. So the earliest, from the research, the earliest we saw of a manifestation of something around pension in Nigeria was in 1961, post-independent Nigeria. 1961, when the National Provident Fund was established, and basically it was largely targeted at the private sector, just to give some different pensions. So there was really no organized pension scheme, so to speak. So the Nigerian Provident Fund was created in 1961, to focus on the efforts by private sector employers to do pension. And then in 1979, finally, government decided to put some legislation around pension for the first time in Nigeria. That was in 1979. So there was a Pension Act of 1979, which now brought in the public sector, civil servants, public servants, statutory bodies, government-owned corporations into the pension scheme. But all the while, all of this was what you call a defined benefit scheme. And I'm going to talk about, in a bit, I'll talk about the difference between the defined benefit scheme and the defined contributory scheme, which is what we are running now in Nigeria. The defined benefit, okay, let me just get to it. The defined benefit, as the name suggests, is benefit. I will pay you this when you retire, and I'll be paying it to you for the rest of your life. That's the defined benefit. So government commits to paying people certain amount, by the time they retire, and they keep getting that money. Of course, you can imagine what the problems, were later on, and we're going to talk about that why that was eventually unsustainable. Governments that is still struggling to pay people that are working today, now committing to pay those that have retired till they die. Now you can tell that, I mean, that was definitely sitting on a keg of gunpowder. It was a time bomb that was ticking, because at some point government wasn't going to be able to afford it. So anyway, that was that act in 1979. Fast forward 1991, there was a pension act where it was dated 1990, but it was actually signed by IBB in 1991. So it was the Pension Act 1990 that came with new set of regulations to provide benefits, in terms of gratuity and pension payment. Now, I should say that sometime between 1979 and 1991, or even between 1961 and 1991, it was said then that gratuities are not entitlements. They are what's that word now? Is not guaranteed. We give you if you have it. If you don't have it, you don't get it. But that act of 1991 now actually made it law that government will pay gratuities when people finish working for it, and they will pay pension, when people finish working for government. Then in 1994, some institution which still exists today, doing something a little bit different from what they were set up to do in 1994, came into being. That was the NSITF, the Nigeria Social Insurance Trust Fund. Now, NSITF was actually a rebranding, so to speak, of the Provident Fund that was established in 1961. So in 1994, the Provident Fund, became the NSITF. And part of what NSITF was doing then was that private sector workers too were able to contribute. So there was a sense of a bit of contributory pension there, but not in a formal setup, where some people could actually say, okay, we're signing up to contributing to a pension scheme that was being administered by NSITF. If we have older people in this room, some of you may have contributed to NSITF. Me, I'm not that old, so I didn't contribute to NSITF. But in the place of work, I have met people who actually contributed to NSITF. It's not the employee compensation scheme that we do now. This one was pension, NSITF managing pension in those days. So yeah, so that was what persisted till democracy came back in 1999. Now, something major happened in 2004, which, for me, I stand to be corrected, in my own opinion, okay, let me not say is the most impactful, but I believe that the pension reform of 2004 remains one of the most impactful reforms that any government has done in Nigeria. It was a defining one for Nigeria. It's really been very impactful. What do I mean that it's been impactful? Think about it, what the pension reform has created. It's created an entire industry. There was not like PFAs in Nigeria before that 2004 reform came. We didn't have the PFAs, we didn't have the PFCs. A whole industry was created out of that. Jobs were created. That industry directly, I imagine it's employing people in their thousands, and indirectly, the whole chain and dependence of people who work within the pension industry. It's helped deepen the capital markets in Nigeria. I'm going to be talking later on how the pension industry has also rubbed off on the capital market. It actually helped to deepen the capital markets in Nigeria. It also helped the insurance industry. Yeah, the insurance industry has also been one of the biggest beneficiaries of that 2004 pension reform in Nigeria. But before I go on talking about, if you look at this timeline that I've done on the screen, you see that I changed my color code from 2004. So what I did was to have a different color code for pre-reforms in 2004 and post-reforms, 2004 going forward. Now, before I continue, I want to drop a bit of a quiz here. So how did we come about the 2004 reforms? So President Obasanjo, of course, he saw what was on ground. Government was doing a defined benefit scheme where they will say, when you retire, we'll pay you. And the liabilities were piling and piling. I'm sure we have all at one point or the other seen pictures and videos on TV of pensioners who are collapsing on a queue trying to get their money, and they're in pitiable conditions. That is because government made promises that we will pay you money till you die, and government is not able to afford it. So the Obasanjo government realized that this is absolutely unsustainable. And then he set up a committee then, which was chaired by Mr. Fola Adeola. Fola Adeola chaired that committee to help, reform the administration of pensions in Nigeria. And of course, they went around, traveled, and came up with the defined contributory scheme that we have. Now, the quiz question I have is this. So that the defined contributory scheme that we do now, it was borrowed from a country. That idea, we got it from a country. Quiz question, what country did we get that idea from? You can drop your answers in the chat box. Let me see who would get that right. Don't go and do Google or ChatGPT. Let me see your answers. I'm going to give about 30 seconds to 1 minute to see what answers people come up with. So the question again is, what country did Nigeria borrow the idea of the contributory pension scheme from? I hope we got that. I'm waiting. Nobody has given it a shot. Okay, I see Germany. Okay. It's not Germany. So let's see what other people think. France, it's not France. Let's see what someone else thinks. Britain, you tried, because yes, I mean, there are some countries that you would expect that those are the kind of places where Nigeria would typically borrow stuff. So you tried, Britain tried, but it's not Britain. Portugal, no, it's not Portugal. Maybe I'll wait for 2 more people to drop where they think we borrowed the idea from. Chile, Shola says Chile. Okay, let's see another person. Address is Chile. Okay, now we have to stop. Now you have to stop. I hope it's not Google too. Yes, you're right. It's Chile. For those of us who probably didn't know, it will come to you as a surprise. Of all places, Chile. Yes, we borrowed it from Chile. So let's talk a little bit about Chile before I go on. So Chile too had been faced with the kind of problems Nigeria had, been faced with in terms of management of pensions. And in 1981, they came up with these reforms that, okay, you know what? Instead of government waiting till people retire and then paying them money that you don't have, why not allow people to be contributing, both them and their employer? Let them be contributing as they are working, so that when they retire, there is money there to actually, pay them their pension. So Chile came up with that in 1981. So they did that reforms. They were the first country in the Western Hemisphere, from what I read, that actually came up with that reform in 1981. So when Mr. Fola Adeola and his team, the committee that President Obasanjo raised, got to work, they found out about that system in Chile, which was working perfectly fine in Chile. They had what they call the AFORs and CFORs. Chile is a Spanish-speaking country, so they have what they call the AFORs and CFORs. The AFORs, now, I may be mixing this up. AFORs, I think AFORs are like the equivalent of PFAs, and the CFORs are the equivalent of PFCs in Chile. So we just went, this is working, it looks good, we borrowed that idea, and that's birthed the 2004 pension reform in Nigeria. So yes, in 2004, an act, of the National Assembly creating a defined contributory pension scheme was enacted in Nigeria. 2006, the first set of operators came on board, so they were licensed, the first set of PFAs, PFCs, closed pension administrators, CPAs, and of course, existing schemes. I'm going to talk more about each of these, I think, in my next slide, so we get to know about them. Yeah, so that happened in 2006. Now, I need to quickly chip in something. So you know that some people had been working and perhaps close to retirement as at 2004. So what did government do? What they did was that, okay, those of you who have 3 years or less to retire, that is, you were going to retire latest 2007, we are not going to migrate you into the new scheme. So if you know anybody that retired latest 2007 or earlier, they never had RSA. They were never part of this scheme that we practice now. So government actually made that the cutoff that those who are going to retire latest by 2007, they should continue in that defined benefit scheme. So those who were going to retire after 2007 were those that were migrated into the new scheme that we have. So that's how those people were treated. So remember, the defined benefit scheme is that government is committing to be paying all these people till they die. So that means there are people who retired before 2008 or latest 2007 that are still alive. Of course, plenty. I'm sure you know one or two persons like that retired before 2007. They are still alive. So those people, government still owe them money. If you see picture of pensioners on TV, it's people in that era. So government still. So we're going to talk about how government is handling them, because is a debt that government actually owes them. So they are still paying those people. So in 2008, the first set of retirees, under the new pension scheme, that's payment of the first set of retirees, that is those who left after 2007 from 2008. So if you were retiring from 2008, remember we said you could enter the scheme. So those who retire from 2008, they were able to get, their own first set of payments in 2008. But of course, you would ask that, okay, somebody who retired in 2008, does that mean just 4 years pension was what the person got? No, there were monies too that they had, that government owed them prior to that, which government had to pay. So there was some transition, kind of arrangement. Then you may also ask that, okay, well, so what happened to NSITF? Remember we said that NSITF, some people were contributing to NSITF. Good. So that money did not disappear. If you look at what I have under 2006, said commencement of operations by first set of licensed PFAs, PFCs, CPAs, that's closed pension administrators, and existing schemes. Now, there are some schemes, I'm going to differentiate later between CPFAs and existing schemes. So schemes like NSITF were called existing schemes. Organizations like CBN, NMPC, and a few other organizations that they had their own pension scheme too that they were doing internally. So for some of those, they allowed them to continue as what is called existing schemes. For some of them, they transferred into what is called closed pension fund administrators. I will talk later about the difference between closed pension fund administrators and existing scheme. But your NSITF became an existing scheme. So for existing schemes, they didn't get licensed to operate as PFAs. So what government said, okay, you can still keep your assets, those funds that you guys have accrued, but transfer the administration to a PFA or to a CPFA. So that's what the existing schemes did. So if you were a contributor to NSITF, your money moved to a PFA called Trust Fund Pensions. For those of you that contribute to, that you have your RSA with Trust Fund, Trust Fund actually took over, the assets of NSITF, the pension assets of NSITF. So if you contributed pensions to NSITF those days, your money moved to Trust Fund Pension, and I would expect that you would have your RSA with Trust Fund Pensions if you were there. So yeah, so that's existing schemes, and I'll talk more about it later. So 2008, first set of payments. 2014, they revised the 2004 Act. So what were a few things that became new in the 2004 Act? I think the major one is the contribution, the percentage contribution. So in 2004, it was 7.5% by the employer and 7.5% by the employee, making a total of 15%. Now that's actually minimum. So what the Act says is that at the minimum, it should not be less than 7.5, 2004 Act, I'm quoting now, not less than 7.5% of the monthly emolument of the employee, so employee contributes not less than 7.5% of his own or her own emolument, and the employer also contributes same, or they can decide to go higher and match each other, higher. Now, another question that people typically ask that, what is emolument as far as the Pension Reform Act is concerned? Is it basic housing transport? Most people will typically do basic housing and transport. Well, what the Act says, so the Act later on, if you check the Act in the addendum, it now tries to define what emolument is, and it says emolument is at the minimum basic housing transport. So some people will do compute their, okay, in those days, 7.5, 7.5. Now, what 2014 did was to increase that for employee 8%, employer 10%. of at least basic housing transport. So some employers could do 8 and 10% of the entire gross monthly emolument, while most organizations would just go with the basic housing and transport. So that was a major change in 2014 compared to 2004. That is, it increased the rate of contribution. And of course, there were also a few other changes. The 2014 Act also made provision for the transfer window. Okay, the transfer window was actually there in 2004 as well. It was in 2004, but pension just never operationalized that until very recently. And I'm going to talk about that as part of changes that have happened in that industry. But, increase in that contribution, yes, I think they also reduced the minimum number of people that could contribute. Before, I think in 2004, you needed to be employing, I think, a minimum of 10 people to participate. But now the new act, with at least 3 people, you will participate in it. And also the scope, the 2004 Act limited the scope to federal civil servants or people employed, by the federal government and private sector. 2014 Act also now mentions states, state civil servants as well. They've been brought into that mix, which is why you also have states. So the 2004 Act was a federal act, which some states domesticated, but 2014 widened the scope and the coverage of who could come in. Mind you, there are exceptions, both in 2004 and 2014, exceptions to people that can contribute. So, e.g., armed forces, the military people, they are exempt from this whole pension reform act. So they manage their own thing by themselves. Why? I honestly don't really know, but well, we always see defense-related things. So they are actually exempt. And in recent times, I think police too have actually been exempted, from this particular act. So anyway, that was 2014 reforms. Then in 2018, what major thing happened in 2018? A guideline was released for fund and micro pension scheme. Now, what's the multi-fund? Before 2018, it was one fund, plain vanilla, mono fund. Just one type of fund. That was what they put everybody's money into. But in 2018, PENCOM now released guidelines creating different types of funds. And I'm going to talk about those different types of funds later on and what differentiates the different types of funds. So currently today, which is part of why, the theme of what we're talking about also says choices, So a lot of people also don't actually know the kind of choices that they have in terms of management of their pension. You just know every month your employer removes money, they emit it, and that's it. You actually have choices. You can actually talk to your PFA and say, okay, move my funds from this fund type to another fund type. So that's one of the choices that you have. Or perhaps you're a Muslim and you say, you know what, I want something that is ethical. Don't buy shares of breweries for me. I want my own to be invested in non-interest instruments. It is now available. So we're going to talk about those options later. So those are the multi-fund scheme that PENCOM created guidelines around in 2018. They also created guidelines for the micro pension scheme. Remember before we had said it was largely civil servants and organized private sector that were covered, since 2004. But, the Nigerian economy is largely informal. So you have a lot of people who work in the informal sector who are not contributing. So they released the micro pension scheme and the guidelines for it in 2018. I remember President Buhari actually signed up the first contributor to the micro pension scheme in 2019, such that self-employed persons or people in organizations who employ less than 3 people, or your vulcanizer, your mechanic can actually also have an RSA account and contribute pension for themselves. That is the micro pension scheme that was launched. It was effectively launched in 2019, but the guidelines were released in 2018. Then in 2020, there was something a lot of us have been waiting for, transfer window. Why must I be locked with one PFA? You remember how, for people who have worked a bit longer, you remember how you got your RSA account? For some of us, we didn't even have the choice. So our employer, I remember my first job was in a bank, after NYC. As part of our orientation, they just brought from one PFA. I will not mention the name of PFA. The PFA. I'm not here to market or demarket anybody, but I'm cool with my PFA anyway. I've not changed. I've been with them since that time. But I didn't choose them. The bank just gave us form and we all filled, and that was it. And I imagine that's the experience of a lot of us here. You probably didn't choose your PFA. Your employer just, maybe they decided for administrative convenience, they will only work with 2 or 3 PFAs, and then they just assign you to a particular PFA. But ideally, that's not the way the Act works. The Act gives you the choice the ability to choose your PFE, just like you will choose your bank. You should be able to choose your PFE, and not just choose your PFE, you should also be able to move. I'm not happy with this PFE. The same way you could easily move your accounts from one bank to another, you should be able to move your RSA from one PFE to another. Now, that had always been in the act, but pension, they said they were working on creating the clearing house and all of that, so they did not operationalize this until, thank God, finally, in 2020, that window opened. So people can now move from one PFA to another now. But of course, with restrictions, you can't do that more than once a year, so that you're not just jumping from PFA to PFA and causing problems within the system. So you can move, but just once a year. I personally know 2 people or even 3 people who have changed PFAs. And I also personally know PFAs that have been coming to market me to move to their PFA. But I'm still loyal to where I'm coming from. And I think they're not doing bad. I won't mention that. All right. So in 2022, some major thing also happened last year. I believe a lot of us, heard about that. Maybe some of us have been taking advantage of it. Access, to pensions for residential mortgages. So you just be like, all that money is just there. I'm not clocking 60 or retiring until maybe another 20 years, and my money is just there. I don't have house over my head. I want to take mortgage. They said I should go and bring equity contribution, and I have money sitting down there. Now, I work with Nigerian Mortgage Refinance Company, as Yemi had introduced me. My company, as our name suggests, we operate in the mortgage sector. We had been part of those conversations that, okay, allow people to be able to access a portion of their RSA balances as down payments for house. Finally, 2022, just last year, PENCOM eventually agreed for that to happen. They created the guidelines for it. So now you can go to your PFA, there are guidelines around that, access 25% of your RSA balance, as part of your equity contribution to owning a home, a residential mortgage. I think that's a very good thing that has happened. Yes, maybe like, it's really not much now. I want to buy a house of 60 million naira, terrace duplex in Aja. How much is my entire pension safe? If I take 25%, it doesn't reach anywhere, but at least it's still something. So yeah. And I want to believe that a few people are already taking advantage of that. So yeah, so that's been the transition from 1961 to 2004, which was the major watershed, and to what we currently have in Nigeria. So what was the rationale? And of course, I've been talking about some of it, but let me just tie those things up here. The reason for us having that 2004 reforms. Before reforms, we had a largely underfunded or even unfunded schemes. So remember I told you that different employers who were having their own schemes, maybe some of those are buoyant, likes of CBN and NPC, maybe they were able to actually sustain their own scheme. But for the federal government itself, it just wasn't sustainable for them. So unsustainable outstanding pension liabilities, which government is still paying till today. Weak and inefficient pension administration. There was no central focus in terms of this is the regulator for the pension industry. We didn't have that. And of course, limited coverage for private sector workers. When you talk pension before 2004, it was largely government workers. Most private organizations didn't send anything concerned with pension. It really wasn't there. Now, what did the reform, what did that reform achieve? It ensures that every worker receives retirement benefits when due. And that has been happening. I know a couple of people who have retired under the defined contributory scheme, and to the best of my knowledge, last I knew, they were getting their monies. And we'll talk about how you get your money when you retire from this new scheme as well. We'll talk about that a little bit later. It also empowers workers and assists them to save for old age. When you see your pay slip and you see, they remove pension, at least you know that, okay, money is being kept aside for me, for the future. Or you open your pension app. I hope we can all access our pension. If you are with a PFA that doesn't give you access to your RSA balances, then you might need to check out and find a new PFA. But just like you will see your bank account balance, you should be able to see your pension balances, So you flip it open and be like, okay, well, there's something to look forward to. Now, I know there are also other concerns that this money safe, is it really appreciating? We'll talk about that, as well. Establish uniform rules, regulations, and standards for pension administration. Of course, that's something, and that's what PENCOM, those are the things that PENCOM does. and of course to ensure compliance and promote wider coverage. Remember we said before reforms, it was just largely public service or civil servants that were concerned about pensions. Most private sector organizations weren't doing anything around pensions, but now they all do by law. Once you are employing more than 3 people, you do. Now we've even expanded it to even cover the informal sector. So the informal sector too is now within the pension catchments now. Although for them it's optional, you can't hold them by force, but at least that opportunity has been created for them to also come into the pension scheme. So those are things that the reforms help to achieve. And what I've tried to do here is just to give a graphic illustration of the pension industry in Nigeria before the 2004 Act and after the 2004 Act. So before 2004, policy formulation was largely federal government of Nigeria. Now, after 2004, it's PENCOM, it's presidency, it's National Assembly. National Assembly will be the ones that, will review the act, of course, taking inputs from stakeholders, including PENCOM, including NECA, including labor unions, all of those when they want to, review the act. Now, why did we say presidency? Yes, because presidency too is actually involved in managing. Remember, we told the federal government still owes some people money. People that retired before this defined contributory scheme, they are still owing them. And those people are still alive. They will owe them till the last person dies. The question is, when is the last person on that scheme going to die? I don't know. Maybe government knows. But they will continue to owe them till the last person that retired under that scheme dies. So the presidency has a role to play in that regard. And of course, PENCOM, the regulator and policy formulator in that regard. Yeah, so regulator back then too was the federal government. Now the regulator is PENCOM. Now, who were the operators before 2004 reforms? Public service pension schemes, private and public sector occupational schemes, the National Provident Fund, which now became NSITF in 1994. Those were largely the operators. But who are the operators today? You have your PFAs. Okay. I was going to talk about the PFA in particular here, but maybe in my next slide, I'll talk more about what each one of them does. So you have your PFAs, you have your PFCs. In my next slide, I will talk about what each one of these does specifically. And you have your closed pension fund. Sorry, that should be closed pension fund administrator, not custodian. It's closed PFA, and you have the authorized or approved existing schemes. Who are contributors? In those days, voluntary by public and private workers. But today, public and private sector workers, now 2014, post-2014, even the informal sector workers are all participating. So you see, we've been able to actually widen that pension net with 2004 reforms. Now, what do each of these players do? So remember we said, yeah, we have PENCOM as the regulator. Now, some states too created state pension boards to kind of also do some form of regulation, so to speak, of pensions in those states. But PENCOM is the overall regulator of the pension industry in Nigeria. So I don't think a state pension board would define regulations that are contrary to whatever it is that PENCOM is releasing. So they would actually be working hand in hand with PENCOM. So today, the approved existing schemes, last I checked, there were 18 of them. I don't know if that has reduced. I don't expect to increase. It can't increase. At the worst, it will reduce. Maybe some decide to pack up. So remember what I said about the existing schemes. So those were your kind of NSITF, CBN, their scheme that they had for their staff, NMPC, the schemes that they had for their staff. Some of them had money, plenty money, that they carried into the new scheme in 2004. So, but they were not ready to go and get PFA license or a CPFA license. So what PENCOM said, or what they asked is that you can continue those schemes, but you will have to transfer your money to a PFA or to a CPFA to be administering those funds for you. So those schemes are still there, they are recognized, but the PFAs and the CPFAs manage those funds and they keep a separate book, for those. If you go to PENCOM website and you download any of their annual reports, they will tell you how much is in the portfolio of existing schemes, So PFAs are handling those monies for them, and CPFAs. Like the example that I give, NSITF is an existing scheme, and their funds are being managed by trust fund pension currently. the PFAs. Now, one interesting thing that has happened in the PFA space or in the pension space as a whole is mergers, consolidations, acquisitions, and all of that. Because Pencom, at different times, just like CBN would do with banking, they will raise minimum capital because they want to have stronger PFAs. They've done that at least once, and before, I think some years ago, we had over 20 PFAs. Now it's down to 19. I'm sure you know one or two PFAs that have been acquired by some other PFA. I mean, maybe I shouldn't mention this, but there are. I don't think there's any risk to it. Sigma Pension is now Access Pension. It used to be Sigma, now it's Access. So those consolidations, acquisitions have actually happened in that market as well, just the way you see it happen in banking. So today, this is as at, the figure I have here is as at, I think it's at the end of last year, was when I checked this. 19 PFAs in Nigeria, and then the closed PFAs. Now, what are closed PFAs? Remember, I said they are similar to existing things. So the closed PFAs too were companies that were doing their own thing before the 2004 reform. But for them, unlike existing schemes that did not want to apply for license, they went ahead and applied for license from Pencom to continue managing their pension. So they gave them a license for what is called closed pension fund administrator. That is, they can only manage pension fund for their organization and not for everybody. So you have the likes of Shell. Shell has a closed pension fund administrator license, and there are 5 others like that. So there are 6 of them. They just continue to manage their organization's pensions and they are licensed by Pencom to do so. So some of them can take up funds from existing schemes and manage it for them. And then you have your PFCs. The PFCs are the custodians, pension fund custodians. Remember I said we borrowed this method from Chile, where they had the AFORs and the SAFORs. The AFORs were their own equivalent of PFAs, and the SAFORs were their equivalent of the PFCs. So what we saw from that system is that separate administration from custodian. Don't let the same person that is making the investment decision be the one that is also holding the fund. I think it's just to create some form of some checks and balances. That would be the wisdom in that. So we have 3 PFCs in Nigeria today. If you handle pensions or payroll in your organization, I'm sure you know them: First Bank, Zenith, and I think UBA. They are owned by banks. The PFCs are actually owned by banks. So there are just 3 of them, as at the end of 2022, I believe, in Nigeria. Now, a little bit about what each person does. So Pencom is the regulator, they are the supervisors. So your PFAs, your closed PFAs, and the approved existing scheme. Maybe I should have even put approved existing scheme here, because approved existing scheme don't actually do the administration themselves. They transfer their funds to a PFA or a CPFA, but in any case, they are there. So their own work is administration, fund management, taking the investment decisions. The PFC collects the contribution, they keep custody of it, and at the instruction of PFAs or CPFAs, they move those monies into whatever instruments they ask them to move the funds to. So when you do your pension remittance every month, for those of us who handle those things, you know that the money goes to PFC, and PFC will tell PFA that, okay, we've received this amount of money. If you don't send schedule, you probably get a mail from your PFA, or at times even from the PFC, saying, give us the schedule for this so that we can apply it as it were. So that's what the PFCs do. They hold the cash. Now, remember I said that one of the good things that the Pension Reform Act 2004 has done for Nigeria is to deepen our capital market. So you have rating agencies who now have, a state of play in that industry. How do they come in? See, when an organization, and we'll see where the money is being invested in, part of the things your PFA looks out for before they invest in, say, a bond, is what is the rating of that instrument that they want to invest your money in. So that's where rating agencies come in. So they play in the capital market, So capital market instruments are rated. The rating it just tells you how risky this instrument is, and for you as an investor to make a decision whether you want to put your money into it or not. Typically, I'm not a treasury person, but I know that typically one of the least risky instruments, or some of the least risky instruments in the market, are government securities. Because you know why? Know-how. whether the country, worst case, they will go and print money from CBN. Federal government will eventually meet their obligations, whichever way. But some more riskier ones could be maybe a company I run wants to also float a bond. You know, there are corporate bonds. Dangote floats corporate bonds. MTN floats corporate bonds. You know, so you could say that, today you put my money into Dangote's bonds or put it into federal government of Nigeria's bonds. If I ask you, some people may probably say, Dangote. Hello, it's riskier to invest your money in Dangote than to invest it in federal government. It doesn't matter how sick or how badly run federal government is. They will pay your money before Nigeria collapses. Worst case, they will print money or whatever. So yeah, government fund. That's why we're going to look at the structure of where our funds are being invested. Insurance companies. I also said that earlier that the insurance industry has been one of the biggest beneficiaries of the Pension Reform Act 2004. Why? The act says that you must provide life insurance cover, right? For all your employees up to 3 times their annual emoluments. That's money. That's premium income for insurance companies. So yes, insurance companies have benefited. Their life business have benefited from this. They play in that space. Annuities. I'm going to talk about what you do when you retire with your money. What do you do with your money? Annuities. You can buy annuities. Insurance companies, a product that insurance companies sell. The banks to play there. Remember, PFCs are largely owned by the banks. So the banks, okay, someone said, is Access not part of the PFC? No, Access doesn't have a PFC license. The PFCs are First Pension Custodian, UBA, and Zenith. Those are the 3. Access has a PFA now, so there is Access Pension. So I also think that, I stand to be corrected, but I think PENCOM doesn't allow you to get both a PFA and PFC license at the same time. I don't think the same entity or group can have both PFA and PFC license. So Access, to the best of my knowledge, does not have a PFC license, but they have a PFA license. So there is Access Pension currently in the country. So they are not a PFC. Yeah. All right. So yes, I said the banks. Now, actuaries. What are actuaries? Now, actuary is some line of business that is not very popular in this country. Actuaries do valuation. What kind of valuation? So remember I told you that government is owing some people who have retired under defined benefit scheme. The work of actuaries in that system is to help do evaluation of how much is this liability that government is holding. What is this liability looking like? That's the work of an actuary, to help them do, like, yes, Stanbic is a PFA. Yeah, Stanbic is a PFA, not PFC. The PFCs are just UBA, First Bank, and Zenith. That's all. Yeah. Okay, and someone is confirming, you're right. An organization cannot own a PFA and PFC at the same time. Yes, it has to be separated. So you either go for a PFC license or you go for a P. I think as at 2007, there were 4 PFAs. One must have dropped out, but there are 3 currently. So yeah, so actuaries do that valuation that, okay, what will be the liability for government over the next whatever years? And part of what they also do is, when people are going to collect their money when they retire, there is something that the insurance companies will do. They try to estimate how long this person will live so that they can face your monthly payments. Actuarial sciences also speaks to that. Then SEC. SEC is the capital market regulator in Nigeria. What concerns SEC with pension? Remember I said your PFAs, they invest your money in the capital market. So SEC regulates that market. So that's where SEC comes to play. So SEC also has a role to play in that industry. I mean, I've missed out 1 or 2 others, but largely these are the people that play in the pension industry in Nigeria. All right. So yeah, how does the system work? A lot of us are familiar with this, but I'll just quickly run through it. So the first thing is, you are the employee, you just got a job, you are fresh out of school, it's your first job. Like I said, they did for me in that bank then. Ideally, you should select your PFA, just like you will select the bank where you want to open your account. But in my own case, and which I believe is the case with many of us, they just gave us form, fill, and that was it. But you should choose. So for HR managers here, people who actually run HR, please don't impose PFA on your new hires, on your entry-level people who don't have a PFA. Don't impose PFAs on them. Allow them to choose. I know for administrative convenience, you probably don't want to deal with all the PFAs in Nigeria, and then you are having schedules for multiple PFAs. I know, but the law says allow, everybody should choose. So please let them choose. So the employee will select a PFA and open a retirement savings account, just like you open a bank account. with the PFA. So once that is out, PenCom will issue a PIN. I think the PIN will usually come in an SMS. The employee has to forward that PIN to the employer that, okay, I am using XYZ PFA and this is my PIN, which the employer will be using to remit your schedule every month. And of course, employer contributes at least 10%, employee at least 8% of at least basic housing and transport allowances every month. It should be every month. I think the law says not later than, I think, maybe 5th day of the next month or so. I don't remember exactly well. Now, one of the major infractions in the pensions scheme is employers who will deduct and not remit. Is a crime. It's punishable. I think it's punishable by a jail term according to the Pension Reform Act. So if you know anybody doing that, I remember some outsourced service provider for us, we had to write them and tell them we're going to report you guys to PenCom, because we realized that they were deducting monies for these people that they sent to us, and they were not remitting their pensions, which is wrong then because they decided to adjust. So it should be remitted. It should be remitted. The only people that are exempt is if you are employing less than 3 people based on the new act, But most organizations employ more than 3 people anyway. So you employ more than 3 people, please ensure that when you deduct, you remit their PFs. So the remittance goes to the PFC actually. Remember that money goes straight to the PFC. PFC will then notify the PFA that we have received funds. And then the PFA will now take the investment decision. So they will invest the funds in approved instruments. So PFC cannot just say, MMM, the returns are high. We want to give maximum returns to our contributors so that they will know that we are the best PFA with the highest. No, PenCom has guidelines. We'll talk a bit more about what PenCom allows them to put money into later. So you can't just put money into anything. So they have to invest in line with the PenCom guidelines. So they do that investment. Now that keeps going on every month, up until the person clocks 50 years or retires, whichever is later. So you don't say, I have clocked 50. The act says I have clocked 50. Now I can go and collect my pension. You can only collect your pension at 50 if you have retired at 50. But if you are 50 and you are still working, you have to continue contributing. You cannot collect your pension money. I know somebody who had clocked 60. He was on a tenured appointment. He had clocked 60 and his tenure still on 60. And the man wanted to collect his pension. And I told him, sir, is either this your 60 years or when you retire, when you finally retire, you are still working, sir. So you are still contributing every month. You are still contributing. So you can't go and collect your pension. The man was like, no, I had to invite the PFA to come and talk to him and explain to him that, Augasa, no, it's until you finally retire that you can get this money. Of course, now there are a couple of windows. So if you're out of job for up to 4 months, I'm sure many of us know that. If you're out of job for up to 4 months, you can get up to 25. You can access up to 25% of your RSA balance. A lot of people japa do that. Once they have japa after 4 months, they apply for their money, collect their money. So you can. And of course, the new mortgage thing now that you want to buy a house, you've seen the house. Of course, there are guidelines that you can also access 25%. So those are the 2 windows by which you can get, your money before you reach retirement age. Other than that, you wait till you retire. Now, what happens when you finally retire? 2 options. One that is the same for both is that you can get a lump sum. Now, I'm not sure now how much percentage that lump sum is. I think it's maybe about 50% or so of your RSA balance. You get it as lump sum. Now, the remaining one, you can do one of 2 things with the remaining one. You can either do what is called a phased withdrawal, which is calculated based on expected lifespan. That's why I said actuarial science comes to play. So they will look at maybe your health history, your habits, whatever, and they will now try and estimate that, Augasta, you are 60. From what we have calculated, maybe you have like 10, 15 years to live. Based on that, they will now be paying you, a monthly pension. Or you may say that, okay, lump sum is not less than 25 and not more than 50%. Thank you very much, Pearl. Yeah, so not less than 25, not more than 50%. That's the lump sum. So the rest is either you can do that phased withdrawal, in which case they will calculate what they think is your expected lifespan and they'll be paying you monthly. Or you go to an insurance company and buy a product they call annuity. So which is a problem where they will also invest that remaining money and, be paying you something monthly plus whatever interest comes out of that. So those are the two options that are available to someone who has retired. And of course, that will continue until the person's demise. And whatever is left, beneficiaries, can take that. So that's how that scheme currently works. Now, transition arrangements. Remember those people that I said government is still owing them. So what is their fate? What is happening to them? Who is handling their money? So the 2014 Act established a directorate called PTAD. Some of us may have heard about PTAD. That's the Pension Transition Arrangement Directorate. So PTAD took over the functions of various pension departments of the public service. So before PTAD, there were various pension departments, that were supposed to be in charge of that defined benefit scheme that government was paying to people who had retired prior to the 2004 Act. There was also one task force called the Pension Reform Task Force. For some of you may have followed that news. There was the head of that task force that the man was accused to have stolen a lot of pension, pension money. There was a time when stealing pension money was in vogue in Nigeria. You probably remember some 10, 15 years ago, stealing pension money was gold. Some people were stealing because government would appropriate funds. Because remember, government owes this money. So they will appropriate those funds, put some people in charge of it, and they will be enriching themselves out of it while pensioners are out there in the sun collapsing and not getting their monies. So PTAD came to solve that. So PTAD now handles that defined benefit. So PTAD's work is to make sure that all those retirees are paid. Now look at the third point I have here. PTAD will therefore wind up after the demise of the last pensioner entitled to pension under the defined benefit scheme of the public service of the Federation. So if you know anybody working in PTAD, that organization will wind up the day the last pensioner on their books dies. Only God knows when that is. Anyway, so, and I think PTAD, they seem to have been doing well. They had this executive secretary who was always in the news doing some fantastic things. Then she later became a minister under the Buhari administration. But I think they are doing quite a bit of some good. So I picked, these screenshots out of their website. They have this thing they call that I'm alive confirmation. So because they are also, just the way we have ghost workers, they are ghost pensioners. There are people whose names have been smuggled into pension lists and they are collecting pension, whereas they are not pensioners. So they do all this continuous verification exercise, which is one of it is what they call the I am alive confirmation, that okay, well, I still there alive, which will still keep paying me. So they do all those confirmation from time to time, their biometric verifications and all of that. So that's how that is being handled. And the money, you say, what money is government? Now, every year when government budgets, part of that personnel cost that is very heavy in the budget is both salaries and also pensions as well. I know that government floated something called a retirement bond or so, where it's domiciled with the Central Bank of Nigeria. CBN actually is meant to hold their accounts where, the government is meant to be putting some percentage into it to service this liability. How effectively they've been doing that, I don't know, but I know PTAD has actually been having some money to pay all of these pensioners. And it's funny to tell you why this scheme was really unsustainable. You know that there is some law, I can't remember, that says that anytime they increase minimum wage, they are supposed to increase, the pension for retirees as well. So you can see it's a lot of burden on government. So someday the last person on that scheme will eventually die and everybody will be on the defined contributory scheme, which should be more convenient for everybody involved. So yeah, back to our defined contributory scheme. So remember, it was 2004, they licensed the first set of PFAs in 2006, and monies have been accruing. People have been coming into the scheme. So the charts here just shows us how the contributors have grown over the years and how the assets themselves have grown. In 2007, just for this is PENCOM report. In 2007, according to PENCOM, there were 2.78 million contributors, largely public size, federal civil service, FCT, and private sector. 2.78 million in 2007. As at 2021, now, if you go to PenCom websites, in preparing for this, I had to go to their website, look at some reports. Their last annual report that I saw on the website was the 2022 annual report, which covered, data up until December 2021. So this data is from the last annual report that is available on PenCom website. So as at December 2021, there were 9.5 million pension contributors in Nigeria. So you can see that growth between 2007 and 2021. That's like 3 times, about 3 times what it was in 2007. So more people are coming into the scheme. The asset itself has grown from 815 billion in 2007 to 13.4 trillion naira at the end of 2021. Wow, that's like 1,300% growth on a straight line there. So you can see, so you just wonder, so where was all this money in this economy? So there was all of this money in this Nigerian economy then, and government was suffering. So yeah, that is how it has really, really grown. So yeah, now I have a question, and I want to see answers in the chat box as well. Or before I ask the question, look at this. I picked this from some newspaper cuttings. Reps move to recover 10 trillion pension fund borrowed by FG. Reps to probe 15.5 trillion naira pension assets and recover 10 trillion naira from FG. Reps move to recover 10 trillion naira pension fund from FG. So my question is, should the government be borrowing our pension? I want to see your answers in the chat. Just yes or no. Yes, no. Should the government be borrowing our pension fund? Let me see. I see a big no from Pearl. Fantastic. Yeah. Let's hear what someone else thinks. Should the government? No. No. Okay. It's fine. I'm not asking for any more. Everybody says no. But why now? Hey, somebody Tena says yes. Okay, so Tena is the outlier here. No. People don't trust Nigerian government. Now, see my own answer. This is my answer. You. Of course, yes. You know, guys, like, yes, they have to borrow. Exactly. So for infrastructure, they have to borrow. Why do you think they created? In fact, I recently met. They do it through bonds. Exactly. So when I see if you can't have access to the government should not. Okay, so I will explain to you why government should borrow and why government has been borrowing. So you see these headlines, When I see headlines like this, I laugh. Is either the reps that are saying this are completely ignorant of how the pension system or the pension scheme works, or the reporters themselves were the ones reporting the wrong thing. Government is borrowing pension funds, and government should borrow pension funds. See, we said as at the end of 2021, there was 13.7 something trillion. You think that money will just sit down idle? No, that money is meant to be invested. In South Africa, the South African government builds infrastructure out of pension funds. That's what pension funds are long-term funds, because people who are contributing will probably have at least 20 years to work. They are long-term funds that are meant to be available for government to actually do stuff. Now, I get the point too. The Nigerian government, the trust level is extremely low. They've been bad managers, of our Commonwealth. The real issue is that citizens don't trust the FG. Government borrowing is not out of place. Yes, I know. So that's actually the problem, that people don't trust the federal government. But guess what? Federal government has been borrowing your pension. And should I tell you, they have been borrowing and they have been paying. It's someone says who ensures the government pays back. They have been paying back. Ask your PFA. Government pays their coupon every quarter. They've been paying back. Remember what I said, that would you have your money invested in Dangote's business or in federal government? Funds have been invested in different portfolios, but they should not be borrowed. So, okay, so maybe we have a problem. Pearl, let me explain them. Investment and borrowing. That borrowing is investment. So when government borrows your pension, your PFA is investing it in a government security. So let's understand that connect. When they say they are investing your pension funds in a government security, that is government borrowing your pension funds from you. Remember, I asked a question earlier that if you had a choice to tell your PFA where to invest your money, would you tell your PFA to invest your money? So let's say federal government has a bond in the market. Dangote has a bond in the market. And your PFA asks you that, who should we invest your money in? Whose bond should we buy with your money? Federal government or Dangote? Which would you pick? If you say Dangote, yeah, and a long thing, no, because Dangote can fold up tomorrow. In fact, I was reading some, that's not exactly borrowing, it's investing in less risky funds. And so when government floats bonds, okay, so Pearl is saying that's not exactly borrowing, it's investing in less risky funds like government bond. What is bond? Bond is borrowing. If I float a bond, what I'm saying is I want to borrow money and I will pay you with interest. So when government floats bonds, they are borrowing money from the market and paying back with interest. So if you look at it from the dimension of, borrow, they are borrowing our money. Hey, this reckless government, they are borrowing our money. Then you probably will reason like the legislators who are saying, no, they shouldn't borrow money. But when you see it as investment, so bonds are borrowing. They are borrowing instruments. They call them debt instruments. You know, if you talk to people in finance, they are called debt instruments. That is, government is borrowing that money and paying back as, paying back interest. Yes, like Tena is saying, the interest is even paid up front. Yeah. In some of those cases, they even pay you up front. Some they pay you your quarterly coupons. Now you have the option to, yes, we'll come to that, Pearl. Now you have the option to choose which investment exactly under the multi-fund. We'll come to that shortly. So I was asking, if you were to choose between let them put your money in Dangote or put your money in federal government bond, if you choose Dangote, it's riskier because Dangote can collapse tomorrow. I was reading something yesterday that it seems the Tinubu government is not very happy with Dangote, that Dangote probably didn't play his cards well in the last election. Maybe he was backing the wrong horse. But the federal government, before federal government collapse, worst case, they will go and print your money and give you your money back. So government securities are the least risky securities on the market. So yes, government is borrowing our pension funds. Government should borrow our government funds. Because when they borrow it, that's what we call investment. That's what the PFAs call investment. So when government borrows it by virtue of their instruments, they are borrowing it and paying it back with an interest. And like Tanner mentioned, for some of them, those instruments, they won't pay you upfront. If you have bought a treasury bill before, they will pay you upfront. What you're meant to get, your returns out of that. For some, they pay quarterly funds to you. So government is borrowing. So let's get rid of that mindset that government is borrowing. Of course, government is borrowing our pension funds. That's the investment in government securities that we're talking about. Now let's look at where the monies have been invested. So yeah, so this is where, as at end of 2021, as at December 2021, this is where your monies have been invested. The 13 trillion naira, see what I have here, I said 13 trillion pension funds cannot sit idle. They must be invested. So where have they been invested? You can see 66% of it, a larger portion of it, is in federal government securities. Why? Those are the low risk securities. They are the safest. So if you say you don't want government to borrow your money, then that means you want to put your money in riskier endeavors. You rather lend it to a bank that can collapse tomorrow So government is actually the safest security to invest in, even though the returns are not as high as those riskier ones, but they're the safest. You will get your money back. So that is why, according to PENCOM guidelines, they make sure they put more of those. So it's a win-win, really. Government is able to access long-term funds to actually do infrastructure. Now that's where there cannot be a disconnect to whether truly what they are borrowing the money for, are they doing what they said they would do with it? That's a different conversation entirely. But our own as contributors is that when you collect that money, pay us back with the interest that was promised. And that has been happening. I can tell you that has been happening. They've not been defaulting. I mean, Ghana defaulted on their sovereign bonds recently. Nigeria, it never bad to that level. And when I say Ghana defaulted, it's not as if Ghana will not pay. They just had to restructure. So maybe some of those bonds that were maturing maybe they were meant to mature at the end of this year, they will just tell their creditors that, okay, sorry, we can't pay at the end of this year. Let's restructure it. We'll pay in a year or two later. but Nigeria hasn't reached that level. We've not reached that level. So yeah, so the bulk of it is actually in government securities because they are the lowest risk instruments available there in the market. 66% as at December 2021 were in government securities, followed by your money market instruments, your fixed deposits, your PFAs also do fix it, they do some of those things, tenured instruments. So those ones, 15% goes into that. Then equities, your shares, ordinary shares of quoted companies, listed companies, 8% of your portfolio in that of the total assets portfolio as at the end of 2021 is in equities. Corporate debt securities, that's where your private sector companies will also MTN, your Dangotes, your Boa Cement, some of them actually float their own corporate bonds as well. 7% of the entire portfolio is in corporate debt securities. Remember I said I would have loved to have this as at December 2022, but PENCOM hasn't published that. So this is the latest on their side. State governments, yes, all those your states that can't pay salaries, they are borrowing. They also have bonds. And the good thing about the state bonds is that there is something called a something standing order, I've forgotten the first name, that before they release money, before they release FAC to them, they will recover all of these monies, all of these payments before they receive their FAC. So for states, in fact, there is no problem. Accountant General's office, every month when they do FAC allocation meeting, before Osun State gets their money, if Osun State floated the bond, they remove what they are meant to pay their bondholders, or any other debt instruments that they have issued. They always remove down straight from FAC. They deduct it at source, so you will get your money. And then there's real estate and others. Others being there are a few other instruments out there in the market too that constitute about 2%, but these are the major ones anyway. So you can see that the bulk of where our monies are being invested. I mean, for Pearl, I'm not going to use the word borrowing again so that people don't like that word. People don't want to hear that government is borrowing our money. Okay, no. But the bulk of our pensions are invested in federal government security currently, and it's because they are the safest instruments out there in the market. So now, what have been those things that have happened, the regulatory changes that have happened, in recent years? One is the introduction of the multi-fund scheme, and Pearl mentioned that. Yeah, that also was one of the very good things that has happened so far in Nigeria. I think they introduced that in 2018 or thereabouts. So now you have 6 fund types. Before it was just plain vanilla one type of fund. Fund 1 is open to persons age 49. This is according to PENCOM guidelines. Is open to persons age 49 and below only. And it must be requested by the contributor. So it's not a default thing. It's not that by default they put your money in fund type 1. You have to say, my risk appetite is high. So the reason why this one has to be requested and for people below 49 years is that more of it is in equities, those high risk instruments. When you buy government securities, you can go and sleep. They will pay you your money. They call them fixed income instruments or fixed income securities. The money the interest that you get, you already know it. Yes, Fund 1, thank you, ISPO, irrevocable standing payment order. Thanks, Tenor. Yeah, Fund 1 is by the way, Tenor is my oga. Yeah, he's my oga from way back. Thanks, Tenor. Fund 1 is the riskiest, absolutely. So that one is for people who say, yes, they have risk appetite. You can play with my money. I still have a long way to retirement. So it's Fund 1. And that's why PENCOM says you have to be 49 years or below to actually invest in Fund 1. And that one, you have to go and tell your PFA that I want extra risk. Because, they hire the risk, they hire the returns actually. So yes, I want more returns. So put my money in riskier portfolios. That's Fund 1. Fund 2 is where by default, if you are below 49 years old, many of us, they put your money in Fund 2. So that one is a moderate mix of fixed income and variable income instruments. So many of us are in Fund 2. In fact, if you have never called your PFA, if you are below 49, you have never called your PFA to tell them to move your money anywhere, your money is in Fund 2 by default. So by default, they put your money in Fund 2. But if you know that you have a higher risk appetite, you're much younger, you don't mind, you can tell them to put in Fund 1 for you. Then Fund 3 is for people who are now 50 years and above. They are getting closer to retirement. much lower exposure to variable income instrument. Remember I said the variable income, e.g. your equities, those are the ones that are riskier, even though their returns are usually higher. So you are approaching retirement. It's not time for us to go and play Naira bets with your money. We have to put it where it is sure. So those are the people that more of their money is in that government securities. So that's fund 3. Fund 4 is strictly for retirees. Remember we said when people retire, they can get a lump sum of up to 50%, and then the rest, they face it. So that rest that is still with the PFAs, they invest it in what is called the fund type 4. That one is heavy on fixed income. That is the one that's no games. We are sure of what is coming out of it. Fund 5 is the micro pension fund. Now, yeah, that's the new one that came in 2019, where people in informal sector too can now contribute. So they put their own in a different bucket. They call it Fund 5. Now, Fund 6 is another one that's been in the market that a lot of people did not know about. Non-interest fund. So you could say, oh, me, I'm a Muslim. Why should they be buying equities in a tobacco company or in a brewery that I don't believe in? So please put my money in non-interest instruments. Fund 6 is available for you. You would have heard that federal government floated Sukuk bonds. Some PFAs invested in those Sukuk bonds. Is Fund 6 they put in it, and there's some money. They have some money in Fund 6. So if you are that kind of person, you could actually reach out to your PFA and say, okay, you know what, I want you to put a portion of my money or maybe all of my money into fund type 6. So those are the 6 fund types that we have in Nigeria currently. So but remember, for a whole lot of us who are below 49, by default our monies are in Fund 2, which is a moderate mix of both fixed income and variable income instruments. Now, the micro pension scheme was another thing that has happened in recent times, which I've also talked about. That's the Fund 5, in which case they now allow participation of self-employed persons, people who work in organizations that employ less than 3 staff, to come into that scheme. So even people that, all those guys that do a job on a daily basis, they can actually participate in micro pensions. So they have a different bucket for them. So that's the micro pension scheme, which has also been introduced by PENCOM. Then the transfer window. I've talked about the transfer window. Now you can move. No PFA can hold you to ransom. At least once a year, you can move if you are not happy with your PFA. So they eventually opened that window. I think that was in 2020, they opened that window. Then restrictions on voluntary pension contribution was another interesting thing that has happened in recent years. Now, this one, it wounded some people. Some of you may know about it, but for those who probably don't know about it, let me just talk about it. So you know that pension contributions are tax deductible. Your pension, when they compute your tax every month, people who handle payroll here will understand what I'm saying. When they compute your tax every month, there are some reliefs that you get. There's a consolidated relief allowance. NHF contribution is a relief. But your pension contribution, your own pension contribution, that's the employee's pension contribution, is a relief. Now you can now say that, okay, I want to do extra. The law allows you to actually say, okay, beyond this 8%, though, I want to do what is called voluntary. That one, your employer doesn't need to match it. It is you yourself saying, I want to put more of my money because I want to save money. I want to put more of my money as voluntary pension contribution. So that is allowed, and it is tax exempt. So a lot of people realize that, oh boy, so if collecting 500K and I decide to put 400,000 as voluntary pension contribution, my tax will be very, very minimal. It helps to reduce tax. And the good thing that was happening then, if you put that money in your voluntary pension contribution, the next week after your employer remits, you can go and knock on the door of your PFA and say, hello, I want to, that VC that I did, that I entered last week, I want to collect it. And they will give you. So people found out that was a way to actually reduce their tax liabilities. And a lot of people were doing it. In fact, I heard that some people who work in organizations where they pay a lot of money or they pay them one heavy bonus, they don't want it to be taxed. They will just move all of that money into voluntary contribution so that their tax is reduced. And then a week or two later, they go to their PFA and they collect their money. Now, there was a man called Fowler who was the yes. People are confessing. So you are one of those who have been wounded. They've checkmated you now. So Fowler was the then executive chairman of FRS, and the man realized that come on, people are actually dodging taxes with this thing. Of course, the states like legal IRS to realize that what's going on here. Things are. It's like people have found a way around taxes. So the Joint Tax Board had to, yes, FRS and JTB. So FRS, JTB, had to actually call PENCOM to the table that, come, you guys need to go and amend this, your guidelines. People cannot just be using this VC thing to dodge tax. So they now had to refine that guideline. Now, you can still do your VC. They are fine with you doing your voluntary pension. If you like, put all your salary there. But you cannot withdraw until 2 years' time. That's how they were able to checkmate people. So when you put VC there, you can't withdraw until 2 years' time. And that 2 years, when you go to withdraw, you can only withdraw 50% of the voluntary. So let's say you have 1 million as voluntary contribution today. You can't get it until 2 years' time. And when you go in 2 years' time to collect it, you cannot collect that 1 million. You can only get 500,000 in 2 years' time. So that way they were able to checkmate people in that regard, and it eventually wasn't attractive. Why should I now carry my money and go and keep it for 2 years? Yeah, so most people stopped once they realized that they had actually checkmated them. Then utilization of pension balances for residential mortgages. That's the latest one that happened just some months ago. I think it was late last year that came. So they released that guideline. You can now access up to 25% of your RSA balance as equity contribution for residential mortgages, which I said is a good thing. At least somebody's trying to buy a house. They said it should bring 20% equity contribution. Whatever it is that you have in your PFA, you can at least access 25% of that, and put it as equity contributions. So that's a good one that has also happened in market. So those are some of the, changes. I'm going to end now. Time is fast spent. So I'm going to end now with challenges and prospects. Now, what are the challenges, that have bedeviled the pension industry and administration of pensions in Nigeria? Number one is rising inflation. So you see now, when we talked about government borrowing, our pension funds or that investment, that's not really the problem. The real problem is inflation. So even though government, like I said, governments have been fulfilling their responsibilities, when they borrow those monies, they have been paying back, and they have been paying back with interest. But hello, what is inflation rate in Nigeria now? It's over 20%. Which instruments, unless you are doing MMM, that will give you a return that matches inflation in Nigeria? So in the real value, so let's say you open your pension account and you see 4 million naira there. You're happy, I have 4 million naira. The reality is that by the time you retire, if this inflation is not checked, you are losing money in the real sense of it. So inflation is actually the big elephant in the room. Inflation is actually the biggest eroder of value of our pension contributions. So that inflation, because we're not getting returns that match inflation, unfortunately. Another problem is unemployment. So unemployment rates, are actually higher in this country now. People are out of jobs, even though MBS did one recalibration of employment figures, but we're just deceiving ourselves. Unemployment is still over 30%. Interestingly, yesterday, the CBN governor, at the bankers, there was this bankers dinner that was held on Friday, I think, and in his speech, he was talking about targeting unemployment and saying that they want to reduce it. He gave a figure which is higher than the so-called 3% that MBS's unemployment is. So people said that, okay, it's like the CBN governor himself doesn't even believe in that new figure. Nobody will plan with that, can't plan effectively with that. So unemployment in Nigeria is actually still over 30%. And with more people out of jobs, it actually erodes value for the pension industry. FGN revenue shortfalls. The more federal government doesn't have money, the more they will come and do the kind of thing that PEL doesn't like, borrow our money. So if government is able to actually make up for their shortfalls elsewhere, perhaps they will borrow less of our pension funds. But for as long as they are still looking for money everywhere, they will come for pension funds. Sorry, they will come for pension funds. Non-compliance issues too is also a huge problem, but I think PENCOM is doing better in that regard, trying to enforce compliance. I gave you the example of a service provider that I knew who were deducting monies from these people that they seconded to us every month, and they were not remitting. So there are still those issues. And then the last challenge that I put, of course, there are a whole lot. These are just a few that I came up with. JAPA. How is JAPA a challenge for pension industry? Now, imagine all the people. I'm sure in this room, each person knows at least 2 or 3 people that have JAPA'd in the last 2 to 3 years. And those JAPA people, they've collected 25%. So basically, that's pension fund too. With more people JAPAing, it will reduce the size of the pension portfolio. But it's also a two-way thing, for the JAPA people too. So that remaining 75% they have is losing value. A friend who is in Canada, was lamenting a few weeks ago that when he left Nigeria, his pension fund was what, I can't remember the figure now, but let's say 10,000 Canadian dollars for the sake of this discussion. Let's say it was 10,000 Canadian dollars. Now, you know what has happened to Naira and how Naira, has fallen, significantly in the last 1 year. The guy said that in Canadian dollar terms, that his pension fund now is probably half of what it was when he left for Canada. So for somebody who is not planning to come back to Nigeria, he has moved to Canada, he has made home in Canada. Keeping money in Naira is not value to him, And then I thought that, okay, that's true. Okay, so maybe what can government, what can PenCom do? Should they just allow those people to just carry all their money since they are not coming back? But hello, money that government wants to borrow. They won't allow you to carry all of that. So once you JAPA, collect your 25% and know that the remaining will just continue losing value, really. By the time you are 60 and you are collecting it, it really doesn't make sense for you anymore. But at least Nigerian economy would have taken advantage. But then the horizon is not entirely gloomy. What are some of those prospects? Contributors and assets should. Now, I use the word should. I was careful not to say will. I said should, because all things being equal, it should still grow, especially with the inclusion of the informal sector. Nigeria is largely informal sector driven. So if more of those people in informal sector can come in, we should have increase in the assets. The assets should grow more. More permissible instruments as the Nigerian capital market deepens. If you look at the state of the capital market in pre-2004 and now, a lot has happened that pension has helped to create, e.g. Sukuk bonds. Sukuk bonds recently came into the mix and they can put your fund 6 into Sukuk bonds. So more instruments can come into the market. There are instruments in the foreign, more developed capital markets that we don't have in Nigeria, like futures. We don't have some of those things. Securitization is still not yet a thing in Nigeria. Some of those things will come to play as the capital market deepens. Investment of pension funds will continue to boost GDP growth. Yes, it will. I should have probably done a bit of calculation around this, but pre-2004, pension funds was less than 1% of GDP. I don't know what it is now, but it's definitely much more better than what it used to be. Insurance market, the biggest or one of the biggest beneficiaries of pension reform at 2004. Insurance will continue to grow, with increase in the volume of life policy related businesses. So the pension is actually good news for insurance, people in insurance business. And then the last I have is that the transfer window will enhance competition and hopefully quality of service. Remember when it was only MTN and EcoNet then that we had in Nigeria, and MTN would tell us they can't do per second billing. And then Glo came into the market and they brought in per second billing. And eventually the MTN that was saying they couldn't do per second billing had started doing per second billing, and the consumers won. That's what competition does. So the transfer window will also increase competition, even though this is a highly regulated environment, but at least quality of service. So a PFA knows that. So they've remitted funds and my RSA holders are not seeing their funds on time. They can move, they can vote with their feet now. So that would also enhance competition and hopefully the quality of service in that industry. And that, ladies and gentlemen, is my last slide. Thank you so much for your time. I had to run through the last part of it because we have really spent quite a bit of time. Thank you so much for your time. I'm glad to take 1 or 2 questions before we wrap it up.
Thank you so much, Tunde. That was explosive. I will suggest that you should be a fellow of the Chartered Institute of Pension if they did not confer that on you. That was, I doubt someone who is in that industry could do a better job. Like Tunde said, we'll take just 1 or 2 questions or contributions. And if we can see those answers right away, that would be fantastic. Any question or comment, please raise your hands so that we can take it and we wrap up in the next 2 or 3 minutes.
Okay, I see a question. How often does transfer window open? So you can only it has opened, but you can only move once a year. Once a year. So someone says, what's the meaning of sukuk? Okay, so sukuk is not an acronym. Sukuk is a non-interest finance instrument. You know, they call them Islamic finance instrument. So it's a non-interest financing instrument. You know, it's like Islamic bonds. They call them Islamic bonds or non-interest bonds. That's what sukuk is. What happens to 50% balance of the voluntary commission? It will remain there till you retire. So that's the idea. They said it will remain there till you retire. So what you can do, so let's say you put 1 million now. Let me quickly explain that. You put 1 million naira now. What if a person lives longer than the estimated years? Okay, I'll come to that. So let's say for the voluntary, you put 1 million and in 2 years, you go and collect 500,000. Remember, you have 500,000. In another 2 years, you can actually collect 50% of that 500,000. So you could also do that to eventually wind it down. But the idea is that they want you to keep it there till you retire, so that it's part of your contribution. Yeah, so somebody said, what if a retiree lives longer than the expected life? That's an interesting one. I honestly don't have the answer to that, but I would imagine that maybe if they estimate 10 years for the person and it's year 9 and the person sees that life is still there, they can't wait, maybe they might have to recompute, you know, and I honestly don't know how they handle that. Pearl has her hands up. You.
Yes, and
okay, so I wanted to attempt to answer the question. Sorry.
Okay.
What happens if you leave? Because they continually invest the money, you can't run out of that money. So the money is continually being invested. So they continue to pay you up until you die. That's the answer to the question.
Thank you. I think we have 1 or 2 more questions on the chat.
Okay. Let me see. I think somebody was asking why it's just 25%. Let me see.
Something
okay, who do organizations send schedule to PFA or PFC? So the money goes to PFC, then you send the schedule to the PFA. But I've also seen instances where, at least in my organization, the PFC at times will send a mail that they received this money, we should send them schedule. But typically we send schedule to the PFA. So at times what we do is to copy both. But there are some solutions now for those who use, I don't know, EPCOS, for example, and I think there are 1 or 2 other solutions like that, that you can just load your schedule and everybody that needs to have access to it, both the PFC and PFA, they have access to it one time without you needing to send individual schedules. So yeah, I'm not advertising for EPCOS, but there are a few solutions like that, that once you just put the schedule once, PFA will see it, PFC will see it. But if you have to send schedule to one person, it's PFA you should be sending schedule to. Yeah, because they are the ones that your account, your RSA is with the PFA. PFC just holds money. So PFC will tell PFA that they have received money, and PFA should have the schedule to now say, okay, move so amount to Mr. A, move so amount to Mr. B.
So we wrap up with question. Can I collect my money and invest myself for my retirement? Any policy like that?
No. So before you retire, we said it's the only 2 windows you have to collect part of your money is either you're out of job for 4 months and you collect it. Now, a question someone could also ask is that, okay, if I'm out of job for 4 months, I have collected 25%, I enter a job, then I lose it again. Can I go and collect another 25% if I lose that or no? I think it's just once. Once you can collect that 25% before you retire. Or you part 2, you can collect it. Basically, you're out of job for 4 months, you can get it. You want to buy a house, yes, you can collect 25%, provided there are boxes you have to tick, or there are requirements that you have to meet, you know, to get that. So you can. Other than that, you wait till you retire. You can collect lump sum, which is maximum 50%. The rest, you either buy an annuity or they do a phase withdrawal for you. You cannot just say, give me all my money, let me go and invest it by myself. No, they won't allow that to happen. Why do PFAs insist on paying only 25% of? No, and I think Pearl helped us to clarify that. It's a minimum of 25. The lump sum is between 25 and the minimum 25, maximum 50. I think what determines it is that whatever is left must be such that it is enough to last you, in meaningful monthly payments. Remember, they're going to be paying you monthly. So what they do is, okay, if we pay you 50%, what is left probably is not enough to last you for the next 20, 30 years that you're expected to live. Then they may say, okay, okay, you take less than 50% lump sum. But that's the guideline, really. So the long and short of it is the guideline that PENCOM has given them. So it's not PFPs that are deciding that by themselves.
All right. Thank you so much, Tunde. We can continue this forever due to the volume of knowledge and exposure. And of course, people are always interested in their future. And economists says that we're all, but we need to make the best of our now. I will just advise that in addition to what pension is doing for us, also do other personal investments. Your side also take it seriously, invest using all the available tools based on your risk appetite and based on your conscience. And of course, don't forget to invest in yourself. Ladies and gentlemen, we'll call it a wrap tonight.
Sorry, very quickly, let me
Yeah, please.
Yeah, sorry. I wanted to please. Someone said, how do we get WT to come and give our employees this insight? My answer, talk to Oluyemi. He's my guy, he's the owner of this platform. Just reach out to Oluyemi. Reach out to Toles. All right, thank you, Toles.
Good night, everyone. Bye for now.